This time, they've gone too far. I'm your host, Steve Van Metre, and thanks for joining me today. And famed hedge fund manager Michael Burry drops a bombshell when he says there's no good options left. Let's over to Business Insider, where we picked today's story up. Big short investor Michael Burry sounds the recession alarm, warning the U.S. economy faces a multi-year downturn. What strategy will pull us out of this real recession? He said in a now deleted tweet. What forces could pull us so? There are none. So we're really looking at an extended multi-year recession. And when he was referring to forces, what is he talking about? He's referring to the central bank, the Federal Reserve. Are they going to be able to go back down to zero? Are they going to be able to do quantitative easing again? Well, the answer is they actually can and are likely to, but the problem is monetary lags hit the economy with a lag that can be anywhere from 6 months or more likely 12 months or longer, which means even if the Fed went to zero tomorrow, it will have no effect. He's also referring to fiscal stimulus, and since that led to a high amount of inflation, you can probably guess the appetite by politicians to bring back large rounds of fiscal stimulus is probably gone, and to that effect, he's saying there are no options left. The investor of the Big Short fame seems to be suggesting that the Federal Reserve and U.S. government have few good options. I think the author got this wrong. We'll say no good options to shore up growth, as he's previously accused policymakers of fueling inflation by flooding the economy with money during the pandemic and warned that could make it tougher and more expensive to stimulate growth in the future, especially if doing so would fuel price increases. And that's the risk we're facing here, is if we do get another big round of fiscal stimulus, and I'm not suggesting that we would if we went into recession, that it could lead to an incredibly high amount of inflation. I don't want to suggest hyperinflation, but it could lead to a massive amount of inflation, and for policymakers, that may be one step they're not willing to take. Burry has been predicting a recession for a while. In June, he noted Americans faced with surging prices and higher interest rates are saving less, borrowing more, and poised to virtually exhaust their savings by Christmas, as we've talked about on this show. Those trends threaten to hammer consumer spending, erode corporate profits, and spark an economic downturn, because when consumers are out of money, you've got a big problem. After all, we're a consumer-led economy. There's no consumption, no economic growth, and what he's saying is all that stimulus is drying up, and drying up fast, and this time there's nothing left in the tank to turn things around. Who is predicting this? He said, there are none. And when referring to a recession, at least one expert took issue with Burry's claim that he's the only one bracing for a downturn, and that was Nouriel Roubini, who we've talked about on this show, when he said some of us have been predicting a long and severe recession and made detailed case for why we're headed toward a great stagflationary debt crisis. And of course, we'll change that, because when you have mass unemployment, you tend not to get stagflation. You tend to actually get deflation, because those on unemployment this time around won't have more money to spend. And there's already some mounting evidence in the data today that shows the labor market is cooling off fast, perhaps even too fast. Let's take a look at the ADP private employment report, showing 127,000 gain for November, missing expectations of a 200,000 print. But look at this. What do we know? Large employers laying off. And you see even up to the 250 to 500 range. But notably, where do you see the growth? Mid-sized employers. And what do I want to suggest? Who are those people? Do you have an idea? Well, I'm about to show you, because the breakdown, well, isn't all that great. What do we note? Of course, construction jobs down, but look at this. Manufacturing jobs are way down. We said this would happen because new orders collapsing would lead to a layoff in the manufacturing sector. And now ADP is saying, yes, that is there. But going forward, we see professional and business services down, financial activities down, information technology down. But look at what we see, the big growth. Leisure and hospitality and education and health services. You can better believe that a lot of those are indeed part-time jobs, particularly in the leisure and hospitality space. So big growth there does not suggest big economic growth coming forward, because that manufacturing sector is a big driver of jobs and growth, and it's saying things are bad. In fact, we got another release of data today that shows, well, it's far worse than we thought. The Chicago PMI collapses to COVID lockdown low, screams recession. In a massive downside surprise, the Chicago PMI survey, which is Purchasing Managers Index, printed 37.2 versus 47 for expectations, a massive miss to the downside, plunging to its lowest level since the peak of COVID lockdowns in 2020. That was below the lowest estimate of 25 economists surveyed, and I want to point out that this print where you see here is consistent with the bottom of recessions. And that's a big warning. That's why Burry is saying, look, we're facing a multi-year recession here because without fiscal stimulus, without monetary stimulus, and still high inflation, the policymakers can't react. And if you look at this data and say, wait a minute, we're already seeing where we're at prior depths of recession, what does that mean in the months to come or in the next year when we find out there is no answer and the economy is actually far worse shape? One thing that fiscal stimulus and monetary stimulus can't do, put people back to work. Under the covers, we note the business barometer fell at a faster pace. Prices paid rose at a slower pace, suggesting inflation may be peaking. Looking at this, new orders fell at a faster pace, meaning demand is falling, and that means employment will follow as well, and it did. It fell at a slower pace. Inventories are rising as demand goes away, but get this, in 55 years, this level of Chicago PMI has not failed to coincide with a recession. Other data that came out today saying things are not looking good and getting worse. U.S. pending home sales dropped for a fifth month on higher rates. Get this, contract signings fell 4.6% in October, with mortgage rates at 7% now. And as a result, pending sales are down 36.7% from a year ago, a staggering number as Americans are seeing home buying conditions at their worst level, at least in a generation, which is resulting in fewer transactions across the board. And we've looked at these surveys in past shows and said, hey, when demand for real estate drops, when confidence drops, when the surveys are saying that no one wants to buy a home, they will lead the headline data. And sure enough, we're seeing it now. Pending home sales are often looked to as a leading indicator of existing home purchases, as properties typically go under contract a month or two before they sold. Of course, we all know that not everything under contract goes through. And this index is based on a sample that covers about 40% of multiple listing service data each month. And here we can see in this chart, the red being pending home sales, leading the yellow existing home sales, and leading new one-family houses sold. So we have a very strong indication that the real estate market is headed much lower. And that, again, drives 20% of the economy. And of course, what do we find out today? The critical job openings and labor turnover survey that has been haunting Powell with a pop-up in numbers, well, it too, as we talked about in yesterday's show, declined. Job openings fell in October amid Fed efforts to cool labor markets. The job openings and labor turnover survey, a closely watched gauge of slack in the labor force, showed there were 10.3 million vacancies for the month, a decline of 353,000 from September and down 760,000 from a year ago, leaving 1.7 job openings per available worker, down from 2 to 1 just a few months ago, as Powell pointed out. Total separations nudged higher to 5.68 million, while layoffs and discharges also rose 58,000 to 1.39 million. The Labor Department is going to release its non-farm payroll report on Friday. The target on that is 200,000, but I'll suggest to you, if this thing misses to the downside, not only can the market rally on hopes that the Fed will cool off and back off, we're going to find out soon enough what Powell's view is. But remember, we still have 2 weeks left. We've got a non-farm payroll report, and we've got a consumer price index coming next week. We'll see what that is, and all signs could suggest the Fed, as we already know, has gone too far. Burry's going to be right on this one. Not only are we going to face a multi-year recession, there's really nothing the government can do. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.